Srinath, in the first part of our discussion, under winds of change, you talked briefly about the digitalization of the trade finance sector. So I wanted to ask you what has been achieved, and with the promise of, blockchain technology, what are the future prospects for digitalization?
This might be a slightly extended answer.
No problem.
Please
We are all
accommodate me.
yours.
So automation of processes is something that has happened for a very long time. I would say longer than a decade.
Right.
Say particularly linking a customer with a bank. So it was no longer about taking a form, typing it up and signing it and then physically delivering it to a bank. If you want to make an LC application,
True.
You could do it using a computer terminal, and through the terminal you could issue instructions for remittances, you could issue instructions for LCs, whatever.
Absolutely.
But there was again limitations there. There are certain parts. Once it reaches the bank, then the bank again manualizes the whole process, transmits it using communication facilities available to the bank. And then again, there's manual intervention at the other end as well.
Right.
So there has been, I said, considerable discussion about digitalization and making it with less manual intervention. And at the supranational level, you've got organizations like the ICC, which has actually set out a digitalization roadmap. Very interesting document. So if you go to the ICC website, you'll find it there. They've also recast rules for digital trade finance. So there is of course the e-versions of some of the old rules that we have.
Right.
But these are all developments that are occurring at a supranational level. The WTO is also getting engaged with that discussion in terms of how to make sure that all the countries in the world have a common approach to the whole phase of digitalization that's going to occur. So clearly digitalization is happening, has happened, and will continue to happen. There's no way out from that.
Right.
Within banks, different levels of, shall we say, investments and activity. But the writing is on the wall. If banks don't digitalize their operations, they'll either find themselves unable to sustain a trade finance franchise, or they'll just be excluded from the system because they're not there. Also at the supranational level, you have organizations like SWIFT, which is the core communication technology and device, facility that's used between banks. They are also investing a lot of effort into digitalizing processes and adjusting themselves to the digitalized world. Now, incidentally, I happen to be connected with a fintech enterprise which is also in that same vein, looking to digitalize certain processes. It's more
wonderful. Tell us more.
Yeah, so the product is called Trade Assets, and you can always look it up on the net. So the genesis of that idea of trade assets is that when you think about banks and their correspondent relationships, those are other banks with whom they may have confirmation lines or discounting lines or guaranteed issuance lines, things of that sort. So in trade finance, for example, every bank that initiates a trade finance transaction needs another bank at the other end.
Sure.
And the other bank at the other end not only performs the important role of being part of the chain of custody of documents, but also gets involved in financing or providing reassurances like adding confirmation, stuff like that to LCs.
True.
So the configuration of correspondent relationship is something like hub and spokes.
Correct.
So there can be one bank, say one big bank, Bank A, that has 500 correspondents, and there are 500 spokes emanating from hub A or Bank A. Like that, there is another big bank with its own configuration of hub and spoke. So like this, imagine the whole correspondent banking market is divided into silos, and in every silo there is a hub and spoke network.
Okay. Yeah.
Okay. Now, the problem with that is all the communication is bilateral.
True.
Okay. And so the one who's at the hub is the one who's controlling the entire conversation. And therefore, when you take an overall view of the correspondent banking market and as a user of correspondent banking services as a trading company,
right,
you'll find that there is, first of all, considerable inefficiency in terms of the way correspondent banking operations are being done, where they're still relying on emails and faxes and telephone calls and
tell us about it.
Excel spreadsheets and stuff like that in terms of operating their business, correspondent banking relationships.
Right.
And secondly, there is no multi-dimensional communication happening between banks, because while you're sitting in one silo, you talk only to people who are in that silo.
Right.
And again, you talk only to the hub to spoke, that's particular spoke. So it's bilateral communication. So when you think about finding risk capacity, or you're looking in terms of new pools of liquidity to fund trade transactions, this architecture severely restricts the ability to find that. That is one problem. The second problem is about price discovery. So the cost of risk of one bank to another, and the appetite that one bank has for another bank's risk.
Right.
These are all bilateral decisions.
Correct.
And so there is no transparency market-wide in terms of what the price of a bank risk should be. Yes, there are market reports and you can form a consensus, but as such, there's no one central marketplace. Like for foreign exchange, for example, you turn on a Bloomberg screen, you turn on any other information screen, and you get a sense of what exchange rates are.
True.
And yes, there are exchange rate markets in different locations like New York, London, Singapore, Hong Kong, so on and so forth. But there's a uniformity,
right,
of sorts across, otherwise that will give rise to arbitrage opportunities. But in correspondent relationship, banking relationships, that doesn't exist. So what Trade Assets has done, it's a portal to an online marketplace where we admit banks as members. And what we are doing is several things. One is allowing every member bank to communicate with any other member bank. So they are no longer part of it. There's no hub there. It's just a marketplace where everybody is of equal status.
Right.
Okay, in terms of membership. And they can reach out to any other bank that they wish, which they would previously either not have heard about, thought about, or have not done.
Okay.
So one is we are creating greater visibility in terms of who's looking for what and what type of transactions are out there in the market. So automatically that also gives rise to dynamic price discovery for bank risk. It also gives greater visibility, particularly to the banks in the emerging markets, because emerging market banks have had a particular challenge following 2008. Following 2008, because the global regulators, or the significant regulators in the financial world, like the US, like in the UK, like in the EU, etc., they have imposed very onerous responsibilities on their own banks in terms of the KYC and due diligence they need to do. Right. So if, for example, there's a bank in a developing part of the world that is sending a simple thing like a remittance through a clearing account in New York, and if there is anything suspicious about that money transfer, the US bank may be completely unaware of what the antecedents of the transaction are, but they'll be held liable if it turns out that the money was related to some criminal activity. Okay. Right. So as a result of which, the banks in New York and the banks in Europe had a real deep second thought and said, should we be really engaging with banks and then suffering the risk of being held up by our regulators and then being, severely penalized for that? So
they shrink.
So as a result, there's been a wholesale, shall we say, discharge of these type of clients. And so there are vast geographies in the world where they've lost a significant portion of their correspondent linkages.
Oh my
And
God.
that had the follow-on effect of affecting trade
Absolutely.
because in trade you need correspondent banks.
Exactly. It doesn't
So
work otherwise.
coming from that perspective, we felt we needed to find a way to address some of the very significant problems that I know you're going to be talking about, and I'll refer to that in terms of supply and demand of trade finance later.
Mm-hmm.
But it came in the way of banks connecting with each other, and pricing of bank risk became completely ad hoc. There was really no sense in it. As a result of which, now that's the point we're trying to address in trade assets.
Because to give an example, the situation that you described, pre-financial crisis and this kind of tightening. I mean, if I wanted to do business with a customer in Munich or Mogadishu or anywhere, right? It was very much possible because the banks there were also part of the they had correspondent bank relationship via their European counterparts, and so they had European counterpart, the European correspondents, and so on and so forth. So whether they added confirmation and things like that is a separate issue, but at least documentary flows and remittance flows for relating to trade definitely happened. I mean, I'm just thinking, right, that because I was a person who did those kinds of transactions on a daily, weekly, monthly basis, and some of those destinations, some of those geographies where my clients were, most people didn't even know that they existed.
Yeah. So this is what we're attempting to address, and in the process, we're digitalizing the whole process of banks doing deals with each other. Mm-hmm. Because we've created access, we've created visibility, we made the pricing more transparent. Mm-hmm. We made it easier for banks to connect with each other. So in the whole process, that supports trade. So we see that as a very good development, and we are at a stage where.
So what are the technologies that you're bringing together on this platform? Like
we're using
blockchain.
Yeah, we're using blockchain, distributed ledger technology. And the reason we chose DLT was because banks are paranoid about security of data. Mm-hmm. Mm-hmm. So that is one aspect that addresses that. Then, of course, there's the issue of storage, which where you store the data. That's a separate matter. Some banks have some stipulations, others don't.
Because their own central bank or regulators may have some.
Sometimes central banks may have a say in the matter. Yeah. So
how do you? So you have flexibility for these things?
No, we are at this point using Microsoft Azure. Mm-hmm. So we're using a public cloud. There can be a whole discussion about public cloud and private cloud, but public cloud is something that is not unusual, right? Because public cloud is a very resilient market. Resilient space in which to store data. The latest security softwares and protections and the latest developments in technology are introduced at a public cloud level. Mm-hmm. So it has served us well. Right. But then there are some banks that have a different opinion in terms of how they want the storage to be done. Mm-hmm. In which case we engage with those customers and we find solutions for them that are mutually acceptable.
Okay. So when was your site launched, and how many transactions are you put through?
I've been associated with since November 2019.
Okay.
And the organization itself actually emerged from Dubai. Two senior ex-bankers came together and set up an organization called Fintech Innovations International. Right. And they developed that product called Trade Assets. So that goes back to, I believe, 2018.
Okay.
Perhaps the thinking must have started much earlier. But
any top-line numbers in terms of like transactions that they have put through, volume?
Yeah, I mean
quantities.
we're already in the several $100 million worth of transactions. Mm-hmm. We have total. We have 59 member banks. Okay. And we are looking to expand that quite significantly. 2020 was a bit slow because decisions obviously were slower to make at that time of uncertainty. Mm-hmm. But we have very substantial growth plans for 2021 and 2022.
Wonderful. Right.
So on the whole, we are extremely positive on the future there.
Right.
Because we know that we're doing what is relevant. We know that it's good for the trade finance markets.
Mm-hmm.
And we think it's something that increasingly both trading businesses as well as banks will start using more actively going forward.
So let me take this to a broader thing. The broader aspect of digitalization. What are the issues that one has to be alert to? We talked about challenges in the physical world itself, and some of the classic issues have have continued to hurt. Right? You gave the recent Bloomberg story, and transactions. Turkey and China, copper, and so on, the copper trade, and so on. So digital, day in and day out, we hear various scary stories. So what are the issues when we think of digitalization of trade finance in general? What are the issues that we need to be alert to?
It took me some time to come to a conclusion on this, but
Mm-hmm.
I have reached a point where I believe digitalization is the way to go.
Sure.
That's where the future lies. That's number one. But is our environment ready for it is the question.
Mm-hmm.
One of the unique problems we have is, for example, restrictions on data storage. I did allude to that in respect of a bank. But now there are government policies where certain countries insist that any data generated out of their environment must be stored locally.
Mm-hmm. Mm-hmm.
And must not be stored on offshore locations.
Correct.
Now, of course, if I'm using Microsoft Azure, my location is depending on where the servers are, and the servers would be in locations which would be, shall we say, having reliable sources of electricity supply. They have the human resources to manage such facilities.
Right.
I saw an interesting article about Facebook having data storage facilities somewhere close to the Arctic Circle.
Yeah. I was going to say that. Yeah, that's where they
Arctic
have.
Circle.
Yeah.
It's interesting because data storage
I was going to say that.
utilities consume a lot of
electricity and a lot of generate heat, and so yeah.
Now that we talk about ESG in these days, so even these organizations are applying some of these principles in terms of reducing demand or consumption of traditional energy sources,
right,
and shifting to solar and renewable
Mm-hmm.
sources, etc. So data storage is one issue that there's no consensus across the world.
Right.
That's one. Second is the legal infrastructure in terms of acceptability of virtualizing documents and processes. Countries are coming on board, but there still needs to be considerable movement on that. Third is investment in the whole digitalization process, because you have to create the infrastructure for that. And you need to have a reliable infrastructure. So you can't have spotty internet. You can't have
True.
machineries that are, shall we say, overused and
got it.
where the technology is not up to date.
Got it.
So investment is also important. Then there has to be wholesale training of people, not only in terms of skill sets, but their mindsets to accept digitalization. If you go back in the 1960s, 70s, when there was talk about computerization in India, the labor unions rose up and said, we lose our jobs. And so there are these type of concerns, and which turned out to be somewhat different as the banking sector expanded with time and became more efficient.
Let me take this to a transactional level. So what should we be concerned about? What should we be concerned about from a fraud prevention, fraud detection? Because, we're talking about virtual documents and putting them through.
Yeah, we've learned enough lessons, I believe, in the physical world as to what can go wrong. So as technologies are developed, the security aspect will also be taken care of. So the genuineness of an electronic presentation and all that, for example, of documents, is something that will automatically be part and parcel of the whole digitalization process. Not only in terms of the choice of technologies, but in terms of how the technology is actually deployed into a solution. and transforms itself into a solution.
Fake
So
videos are getting better, Srinath.
I know, but again, we're
I'm just
learning.
pushing you. I'm just
We're
pushing
learning.
you. Yeah,
We're learning.
Sure. Right.
So mistakes will be made along the way. Some tragedies will occur, but we will get better at it. And I firmly believe that as trade finance gets more and more digitalized, and with the corresponding advent of available technologies, the generation after me, for example, will be living in a wholly different world when they're practicing trade finance. And it will be a more organized, a more efficient, a more transparent world.
Right. So what have been the first
positive
experiments, right? Whether for your site or for the others, broadly speaking, some global banks put through some trade transactions completely using blockchains. That's what we read in the news.
Yes.
So can you as a person, deeply invested in this and talking about this, you tell us how some of them went through, and what were the successes, what were the challenges in some of those pilot initiatives.
My reading of it is that there have been pockets of activity where there are particular banks dealing with particular clients.
Right.
So as such, there has not been a wholesale transformation of that process as yet.
True.
So that is in the works, and it will happen. It's a matter of time.
But those individual or experimental transactions go on fine?
Yeah, the experience has been positive. That's
very
the
good,
reports.
Very good.
And so that gives confidence to the banking system to proceed further. It also gives confidence to the central bankers, because central bankers audit the books of their constituent banks.
Right.
So the central bankers, particularly people like MAS and Hong Kong Monetary Authority and FCA,
RBI,
they are very heavily invested in these conversations with guidelines
True.
and giving their input. So there's a constant communication going on.
Right.
So going forward, I do anticipate that the security aspects of it will go hand in hand. I don't see that as a major challenge.
So some of these techs have been available for some time, right, already. So why has it taken more time to do this digital transformation of trade and trade finance, right? I heard you talk about various technologies, and like it occurs to me that hey, it's not absolutely sort of like new, right?
Yeah, technology has been around, solutions have been around for a long time, but adoption has been slow. Right. Even speaking for trade assets, one could always ask the question, why only 59 banks? But the point is, we think it's a badge of honor that we have 59 banks. We do value those 59 banks being on board. And when we think about it, it's about, one is probably mindset and the way in which banking businesses are managed. So if I were to take specific reference to trade assets, where we are in the business of making available bank risk capacity and funding pools available from one bank to another.
Right.
There are banks out there who say that I would still like to retain my ability to be deciding how I deploy my capacity for bank risk based on what my customers want, rather than going to an open marketplace.
Right.
So we are in the process of, debating that point and saying, where's the value add in coming to trade assets as opposed to trying to do it on your own in terms of keeping your capacities reserved for your customers and not deploying it for other banks for transactions you might otherwise not be involved in. But the thinking is changing. And it's a process, and it's a transformation of the mind as well as the way in which, as I said, businesses are managed within the bank. So the metrics by which somebody's performance is measured will also have to change.
Absolutely.
In order for you to adjust to this digitalized world that we're going to live in. So
true.
Then I spoke earlier about things like human resources, etc., acclimatizing to this whole new world.
Right.
So a whole lot of things happening, but clearly digitalization and the introduction of technology. There's also discussion about artificial intelligence and machine learning.
Yeah.
There's already optical recognition technologies that are being used for checking documents. Transmission of documents through electronic channels is another way in which to do it securely is also in practice it's happening, and it needs to be more widespread.
Right.
So some banks have come together and collaborated in certain ventures. In some cases, some banks are doing it on a standalone basis.
Right.
So there are various initiatives happening, and it's an exciting time to be involved.
So, you mentioned, apart from that, you also mentioned that, the next generation and the one after that will have a completely different experience when it comes to trade finance. So talk about the future trends for careers in trade finance and trade in general.
I think there'll be a whole transformation there too. One is, I think, one of the skill sets that will be required is to merge your thinking about your understanding of trade finance and trade finance processes, which again are undergoing a transformation, with merging that with the needs of the customer in the digitalized world.
Right.
That'll be a whole different equation. And then dealing with other counterparties in the banking sector. So the uniformity with which we now respond, it may take some time to achieve that same level of uniformity going forward, because everybody's getting used to this digitalized world. So there will be hiccups along the way. So I anticipate that going forward, comfort with use of technology is going to be an important part.
Right.
And also when you're looking at propositions, trade financing propositions, you don't focus on the borrower alone. You zoom out, look at the supply chain that they're located in, and then determine what type of solutions best fit the customer's needs. Right. Because there's a fundamental, shall we say, requirement, need to do that. Because when you do a risk analysis of, say, one company within a supply chain, their risk profile is not determined by what you see contained within them. There are risks occurring up and down the supply chain, which has an impact on them. So therefore, you need to have a much more expansive view in terms of risk analysis by zooming out and looking at the whole supply chain and having a more expansive view.
So that would mean something like, if I may be allowed to use this expression, trade finance architecturing, right? Designing and architecturing for specific transactions or for specific set of clients. It's like decision architecture, right? That you don't look at it only on a single attribute or a single thing, but you zoom up and say that okay, fine, this is the landscape like, and these are the pieces that will fit together, and that will give me the best solution.
Well, to translate what you just said, one way of looking at it is, instead of looking at specific and one-to-one transactions, it's about trade flows. Exactly. Because at the end of the day, as a bank or as a financial institution, and here again, the architecture of the trade finance marketplace is changing. Right. We'll talk about that after I just complete this point. So banks, when they're looking, or financiers, when they're looking to finance customers, they don't want to be talking to a customer every day and say, what's this new transaction for the day? Because even businesses have certain patterns, have certain flows, and there's certain uniformity in those flows. Right. So a financier comes in and says, I'd like to capture, say, a percentage of that flow, or 100% of that flow. Let me just take that whole package and design a trade finance solution which takes into account the particularities of that particular trade transaction, as well as the digital capabilities that the banks brings to the table. So you see a lot of that happening, for example, in the supply chain finance space, where banks are making strenuous efforts to actually capture whole swaths of a business activity, and then make that same solution available to other clients who might require something similar, because that reduces the cost of acquisition of clients for the banks.
But if that re-architecturing takes place, then it can also bring in non-banking actors, right? And
that's precisely what's happened. And I said there's been a reconfiguration in the market architecture. Today, I told you earlier about, should we say, the SME sector being abandoned by many of the large banks, right, in many parts of the world. So they started looking for alternatives, and then there were providers out there. So today you've got digital platforms for receivable finance. You've got digital platforms for auctioning of home loans, reverse auction of home loans. You
Mm-hmm.
hear about that, right?
Yeah.
In Singapore. We've got platforms, we've got digitalization of documentary processes between customer and bank, bank to bank, and then bank to customer.
Right.
So all this is happening. And then you've got initiatives like trade assets, which is occupying a space all of its own.
Mm.
So that has brought in a lot of technology companies. So you have the fintechs.
Mm.
So yeah, I classify fintechs into two fintechs that offer something in the nature of risk and financing services. So like financing platforms, etc. That's one type of fintech. And then there's the other type of fintech like ours,
Right.
which completely redefines the marketplace and enables two banks to come together on a transaction. But the transaction itself still is done directly by those two banks. We are not intermediaries in the transaction, whereas in a financing platform, the fintech provider could be the intermediary in the transaction.
Okay.
So there are different forms, and then there are non-bank financial institutions, funds that come in and are offering trade finance now. They are not subject to the regulatory requirements that the central bank has on licensed banks. So to an extent, they have a little more flexibility. But that's not to say that they're not diligent about the way they do risk analysis. It's just that their regulatory framework is totally different.
It's different, yeah.
So they operate under different conditions. So you've got funds, and then you've got the insurers, for example, coming into the secondary market for bank risk.
Mm-hmm.
You've got, so insurers not just doing insurance, that's the point here.
Right.
And then you've got digital providers of banking services.
Right.
So the whole marketplace is changing. And so there was a point in time when I came into the banking business that if you want to do trade finance, you do it in a bank.
Right. So now that is changing.
That's changed.
So let me ask you a quick question. Do you foresee that this would be the state of, the state of supply and demand for trade finance? This is how it will be reconfigured if you're looking at it in the next 5 years or longer?
There's been a serious problem in the world in terms of trade finance supply.
Right.
ADB, Asian Development Bank, and ICC many years ago estimated that the gap between supply and demand is $1.5 trillion.
Right.
So that means demand exceeded supply by $1.5 trillion.
So there's room for the non-banking actors as long as they manage risk well. Yeah.
With the pandemic, there have been some institutions that have suggested that that gap has increased to $5 trillion or in the region of somewhere between $3 to $5 trillion.
Wow.
And that is a huge problem. It's a serious problem that will hold the whole world back.
Right.
So the advent of non-bank institutions, whether in the form of fintechs or basically funds or other non-bank financing institutions, NBFIs, we might refer to them, and the advent of other financial institutions like insurers, etc., coming into the play, will definitely have a beneficial effect, but we're still far from filling that gap. I was just now, we had a break, and I was looking at my phone at some news, and I noticed that there was an article that ICC, International Chamber of Commerce, has engaged with a fintech firm to address the issue of trade finance gap. So it's a very current issue. It's a very serious problem. And to an extent, microfinance has helped. Say, for example, you take the case in India. There were disadvantaged sectors which were not receiving any financing. So the microfinance has helped. But there's a huge gap between what the formal banking sector does and what microfinance does. There's a whole gap of customers there who are still unserved. Nationalization of the banking system, to a degree, may have helped, but with it came the inefficiencies of the public sector, unfortunately. But there are still gaps in the market like that in developing countries. In the developed countries, of course, the situation is better.
Fascinating discussion, Srinath. And, it's wonderful that you shared, such current information as much, even as much as like news flow that flowed into your mobile as we were recording this session. But fascinating insights we got at the end of it, and definitely we would look forward to have you back. And maybe we could explore some of the topics in greater detail and so on. So thank you once again. Thank you very much for this enlightening discussion. I enjoyed it thoroughly.
I thank you for giving me this opportunity to speak. It's not often that I get a chance. I do talk about it in bits and pieces in my training session, depending on what the training session is all about. But to have a free flow conversation on a whole range of topics like this is by itself thought provoking. So thank you. And yes, it's been enjoyable. And your questions were all very good.
Thank you for joining us in yet another episode of Move Conversations. Hope you enjoyed this episode. Please subscribe to the Move Conversations YouTube channel and press the bell icon to get notifications of new episodes. Thank you very much. Till I see you in the next episode. Thank you very much. Have a great day.